What role does property and casualty insurance play in powering the growth of renewable energy? In this video, we'll explore how insurance is helping accelerate the renewable energy transition, the unique risks involved, and the challenges insurers and developers must overcome to support clean energy growth. Let's start with the basics. As the world pushes toward decarbonization and cleaner energy sources, massive investments are being poured into renewable energy projects. Solar farms, wind turbines, battery storage, and more. But with new technology, infrastructure, and operating models come new risks. That's where property and casualty insurance steps in. P&C insurers provide critical coverage that allows renewable energy projects to secure financing, operate with confidence, and recover quickly when something goes wrong. For example, before a solar farm can be built, lenders typically require proof of insurance. That means a project can't move forward without a risk transfer solution in place, making insurance a key enabler of renewable energy development. But insuring renewable energy isn't the same as insuring a standard commercial property. These projects often span remote areas, use emerging technology, and depend on highly specific operating conditions. The risks are complex, which creates both opportunities and obstacles for insurers. So what kinds of risks and coverages are involved? For solar energy, insurers provide coverage for things like panel damage, equipment breakdown, and weather-related losses like hail or windstorms. Solar farms also need general liability coverage to protect against third-party injuries or property damage. During construction, builders' risk coverage is critical to protect against fire theft or natural disasters before the facility is operational. Wind farms come with their own risks. Mechanical breakdown of turbines, blade damage from extreme winds, or even ice throw from rotating blades. Offshore wind farms add marine and environmental risks to the mix, requiring specialized coverage that goes beyond traditional land-based insurance products. Battery storage systems are another growing area. These facilities store excess power from renewables, but they also bring fire and explosion risks due to the volatility of lithium-ion batteries. Insurers offering coverage in this space must understand the engineering behind battery systems and how to manage emerging safety concerns. There's also business interruption insurance, which protects against lost revenue if a system failure or extreme weather event shuts down operations. And increasingly, project owners are looking for coverage that responds not just to physical damage, but also to performance guarantees and power purchase agreement disruptions, more financial and operational risks than traditional insurers have historically covered. Now here's where the challenges come in. Because many renewable projects are relatively new, there's limited historical claims data available. That makes it harder for insurers to model and price risk accurately. This lack of actuarial history often results in higher premiums, tighter underwriting guidelines, or in some cases, limited coverage availability. In fact, some developers have turned to self-insurance or captive insurance structures to fill the gap, especially for large-scale solar or wind projects where traditional coverage is either too expensive or too narrow. For example, a solar developer might set up a captive insurance company to insure its own assets, then use reinsurance to manage the biggest catastrophic risks. This is especially common in jurisdictions where extreme weather risks, like wildfires, hurricanes, or hail, have made traditional insurance coverage prohibitively expensive or unavailable altogether. In some parts of the United States, solar projects have struggled to find hail coverage at reasonable prices, despite the rising frequency and severity of hailstorms. But there are also opportunities. Insurers that can develop better risk models and understand the nuances of clean energy technologies will be in a strong position to serve this growing market. Collaboration between insurers, reinsurers, engineers, and renewable developers is helping to build smarter risk assessment frameworks. using tools like satellite imagery, drone inspections, and AI-based modeling to better understand exposures. Some insurers are creating specialized underwriting teams for renewables, while others are working with technology providers to develop performance-based products. For instance, parametric insurance can offer fast payouts based on weather triggers like wind speeds or solar radiation levels, rather than waiting for physical damage assessments. This kind of innovation could play a big role in managing operational risk and supporting faster recovery. Looking ahead, the future of renewable energy insurance will depend on how quickly insurers can evolve their products, data, and partnerships to support the pace of global energy transition. With more aggressive climate targets, more public and private investment, and the growing role of distributed energy systems, the demand for specialized P&C coverage will only increase. New technologies like hydrogen fuel cells, floating wind turbines, and carbon capture projects will introduce new risks and demand new insurance solutions. As the sector matures, insurers that can blend technical expertise with creative risk transfer solutions will have the opportunity to help shape the future of energy. So what's the takeaway? P&C insurance plays a vital role in enabling renewable energy growth, but the industry must keep innovating to keep pace with evolving technology and climate risk. For students or early career professionals, renewable energy insurance is a rapidly growing niche full of opportunity, whether in underwriting, claims, engineering, or risk analytics. If you found this video helpful, don't forget to like, subscribe, and follow Insa Knowledge for more insights into the future of insurance and careers that make an impact. Thanks for watching.